Hi. It's always a challenge to have the graveyard session, but I hope you're all suitably caffeinated. I will not talk about development finance. I'll talk about finance. So what are the basic tenets of finance, right? What do they teach you? Finance 101. They teach you finance is the brain of the economy. It allocates capital. Finance basically takes money from there's too many savings, not enough investment opportunities, to where the opportunities lie, and where there are not enough domestic savings. Number 3, do not put all your eggs in one basket, right? And number 4, at some level, finance, like any other sector, eventually can only grow in line with the economy, right? So it's okay to have a tiny hedge fund generate returns of 20% year after year in an economy growing at 2 or 3%. But you cannot have the whole financial sector do that. And yet, that's exactly where we are. So we are at the end of what has been a fantastical bull cycle in the global financial system in general, in particular in the OECD financial system. If you look at the past 3 to 4 decades, you look at CalPERS, you look at PGGM, the Norwegian Oil Fund, all of these large institutional investors, the kind of people you would expect to put money in the kind of countries that people in this room are interested in, right? Over the past 3 to 4 decades, they have generated returns, annual returns of 6 to 8%. And these are the financial system. In a global economy and in an OECD economy that has actually only been growing at 2 or 3%, right? So this is exactly what has happened. And what does this tell you? This simply tells you that this cannot continue. And we are starting to see the system hit its limits. What are we seeing? Let's look at the discussion in central banks. I was recently lecturing at a couple of them. We are hitting the limits of monetary policy. If you cannot induce a company or an individual to borrow when you get paid to borrow, right? I mean, what more can you possibly do? Imagine how we grew up and what we thought of what borrowing was. And borrowing, the whole concept has been turned on its head, right? And even then, this money is not making its way into expanding productive capacity. So you have German government bonds, negative territory. Is Germany investing? The answer is no. Many companies in Europe, I think 5 or 7 up until now, have been borrowing at negative interest rates. Are they building new factories and plants? Not really. You have mortgages in Denmark going at negative rates. What are they doing with the mortgages? They're just refinancing the old one, right? So the link between borrowing or taking money and actually expanding productive capacity, which is what eventually generates growth, which is where profit comes from, has broken down. So that's one big problem that central banks, from the Fed to the Bank of Japan to the European Central Bank, are discussing. Number 2, what has been a fantastic run for all the pension funds has been that, hey, everybody thinks that we are going to do great. So if you look today, 70% of the value of some of the largest pension funds in the world has not come from new pension contributions, but is accumulated financial returns, okay? This cannot continue, which only means 2 things. Either you will have to make higher and higher pension contributions, or your pensions are going to fall. I mean, the political economy of that is horrible. In fact, even as we are in this room, the Dutch and the Swiss parliament are having discussions about cutting pensions. Can you imagine what the backlash of that will be if this starts spreading? But this is exactly what is going to happen, because the expected returns of our largest institutional investors, from CalPERS to the Canadians to the Norwegians to the Dutch, are expected to fall from 6 to 8% to 2 to 3% at most over the next decade or 2. Okay, so that's the second problem. Third, if you look at all the global forecasts first now, what's happening across the world, growth forecasts are falling, right? Within the OECD and in the emerging world. And things are expected to sort of get worse, maybe, and then maybe we are even expected to have a recession, and then maybe things will get better. Okay, so those are the 3 problems that are generally not discussed in this room. And the 2 problems that were discussed in this room, even today, the share of renewables in the energy mix today is more or less the same as it was 10 years back. So we're running faster and faster, investing more and more to stay in the same place. And, of course, as you've heard repeatedly, the SDGs are not getting funded. So we think that these are exactly, this is the parable of the 5 blind men and the elephant. And the elephant is the failure of financial intermediation, the basic failure of finance to do its job, which is to get money from where there is too much within the OECD to where there is too little, right? I mean, we are at the technological frontier. The incremental next model of iPhone you buy may not increase your productivity much. In fact, it may actually decrease it, right? We don't need that much money anymore. Yes, you can improve German infrastructure. I mean, you can definitely improve New York airports. But surely that money can do far greater good, be employed far more productively, far more profitably, where there is an actual shortage of capital, and that is not within the OECD. Time was when the absolute number of workers in the OECD was rising, up until about 2010. Okay, and that is half of global growth. Half of the growth has come from an actual increase in the number of workers, and the other half has come from an increase in productivity. Now, within rich countries, the absolute number of workers has started falling, so it's not a big driver of growth. And second, again, because we're close to the technological frontier, there are limits to how fast we can grow. If we grow slower, financial returns will be slower. And yet, we have more capital than we know what to do with. We have $80 trillion of capital within OECD long-term investors that is more or less trapped within the OECD. And that is why you have this bizarre phenomenon of being paid to borrow and yet still not investing. So if you look, 2 examples. The German government bond market, only 15% of bonds are in private hands, right? So if you're a large insurance firm, if you're a large pension fund, you want to go buy sovereign bonds, safe sovereign bonds, you can only have 15% to choose from. The rest is all held by central banks. And the European Central Bank is once again going to start QE, okay? S&P 500, fantastic return since 2009, 320% or so. And yet, as of today, the S&P 500 has far fewer shares than it did 10 years back. Companies have been buying back their shares. There's been a number of delistings, and the flow of new IPOs has shrunk. So today, the S&P 500, despite being significantly higher than it was 10 years back, is actually representing a far smaller share of the productive economy. Again, that link between the 2 biggest markets we have in the OECD, the bond market and the stock markets, and an expansion of productive capacity has absolutely, completely, potentially irreparably broken down. Whether your interest is in normalizing monetary policy, or your interest is in increasing global growth, or your interest is in actually ensuring the viability of our pension system, or you actually, God forbid, happen to care about climate change, or, as the geeks in this room, we actually care about development and the SDGs, the answer is roughly all lying in the same direction. There has to be a large scale reallocation of capital from our home countries to those places. Every single thing you heard today, everything you will hear, even from Mark, is very, very important, but it's a second-order thing, right? It is death by 1,000 cuts. This is not a strategic decision taken by the financial system to say, look, we're going to actually screw up our own future, you know? The banks in the European Union are trading at 0.6% book to value, which basically means the market is saying to the European banks, hey, we are better off if you shut down and then you return our money than you are if you continue to operate. Even the giant of the market, you know, Goldman Sachs is trading at a book to market value ratio of 0.9. So the market is basically saying to Goldman Sachs, you're destroying value, right? That is the level of failure. 1/3 of asset managers within the OECD are expected to shut down or fail or be taken over within the next 3 to 4 years. That is where we've hit the limits of what we can do by deploying OECD capital within the OECD. Every single other answer must come from outside. That is also the only way you can diversify your risk, because, like it or not, we are risky. To end on this note, what matters in basic finance is relative risk and relative return. Is Sierra Leone risky? Yes. Is India risky? Of course, right? But so is the United States. The world's 3 biggest sources of political risk, which I grew up thinking lay in Africa or Asia, are now the United States and its present management, this country and its present management, and the euro crisis, right? Currency volatility in the G10 currencies, that includes the Swiss franc, the British pound, and the Swedish kroner, is greater than the emerging market volatility of currency. Again, currency risk was something that was in here. And even as these risks have risen, not to mention the fact that all these OECD countries are all highly financially and economically interconnected, right? I mean, the euro crisis just spilled over from one country to the other. So it's highly correlated risk and rising that we are exposed to, even as the returns we can expect have fallen drastically. Just to finish on the equation, what matters is relative risk and relative return. The relative return available in OECD countries has fallen drastically. It's not likely to go up much. The relative risk of the OECD is rising, and it's highly correlated. So if you have any basic financial sense, there is only one thing to do, and that is to deploy large, and I don't mean billions, I don't mean a few 100 million here and there, large billions. And when we can remove the word development from development finance and just talk about finance, that is when we would have succeeded. This discussion doesn't belong in the tiny geeky community of development bankers and NGOs. This discussion belongs at the central committees of the European Central Bank, the Federal Board, the pension regulators. That is the only way. And the end for the good news is the world now has more than enough capital. We've finally reached a stage where the vast majority of renewables are actually economically better than the vast majority of fossil fuels. We've got more than enough talented people. The first order problems are all here. And the interests of central bankers, pension regulators, the growth community, the development community, and the climate community are all roughly aligned. The future of climate change will not be decided in Europe, not be decided by energy vendor in Germany, but in the developing countries. The future of global growth will be in developing countries. Your pensions, whatever have you. The answer all is right in front of us. We have to get going, and we have to get going now. Thank you.